Good morning and welcome to another edition of the Main Management Weekly Market Note. As usual, I'm Alex Varner, Managing Director of Research, alongside
James Maxwell, Director of Research.
Let's get into the week that ended August 14th. Here's our offerings as usual. Performance, again, far more blue than red. Energy up the most on the bottom right there, trailing week up almost 8% in the week. 4x the next closest one. Year to date, energy's also boosted commodities, up 40.8%. Energy is the best performing sector, up almost 39, followed by tech up 32. Tech's really come kind of roaring back here after that correction we had. And then on the bottom left there, you can see commodities helped by energy, the top performing major asset class for the week. Recession dashboard, not a ton's changed. I think overall the kind of data this week, this was more inflation data. And basically the long and the short of it is the Fed has more room to kind of wait and see.
Yeah.
They don't have their hand forced by this. Headline CPI came back from June's big drop, but it was up, 0.07% month over month, which is basically in line with forecasts. Year-over-year figures down to 3.3, the lowest in a few months. So that's good. The Fed likes to see that. That gives them some breathing room because inflation's moving back down. It's still, prices are still going up on an absolute basis, but the year-over-year numbers are slowing. Energy weight on the decline was down 1.5% month over month after being down almost 6% in June. Core CPI was up 0.22% month over month. Again, in line. It's back down to 2.47% year over year, which is the lowest since March of 2021. Before we saw that big spike up to 6-7% on the inflation figures. So again, as we said, gives the Fed some room to just kind of wait and see. I think most of the stuff I've seen coming out over at the end of the last week, kind of, synthesis, what we do similar to this, has been basically now the Fed is kind of more likely on hold.
Yeah, that's what I've been seeing too. Like September, the odds of a rate hike in September have dropped to now somewhere around 30%.
Yeah.
Previously, they were above 50, so more unlikely than likely.
Yeah,
in September
I think
at least.
Through the end of the year, you have seen these odds come down a bit, but they're still forecasting, call it 1, maybe 2. We're probably closer to 1 now, given the kind of inflation data we've gotten. On the left here, we're showing Shelter. Shelter is one of the bigger weightings in the CPI basket at basically 36%, and it was up 0.14 month over month, slowed to 3.16 year over year. So that continues to be kind of a big kind of push or weight on the headline figure. And then on the right, you can see gasoline, which we talked about energy, but gasoline helped bring energy down once again. Weight on the headline figure. This is core. This is not part of core. But gas prices were down basically 2.9 month over month in July, following almost 10% decline in June. But they're still up almost 25% from a year ago. So that's not ideal. But again, you got to start kind of taking out or readjusting for the spikes we had earlier this year when Iran kind of kicked onto the scene. And it's worth noting also at this point in the year, we're now at this was September, so the August readings. We're in September on the gas prices; those are more real time. But gas prices are above $4 nationally, and that's the highest they've ever been this late in the year, according to Gas Buddy. So people having a lot of fun at the pump on a weekly basis still. In addition to CPI, we got PPI. On the left, it was down for the second month in a row at basically, minus 0.03%. So basically hardly changed, but well below forecasts for a 0.2% increase. It's now back down to 4.66 year over year, lowest since March. Food and energy contributed to that dip. Core PPI on the right was up 0.24% month over month, also a bit below forecast for a 0.3% figure. That year over year is back to 4.16, again, also the lowest since March. And then, so these kind of reaffirm the CPI readings that basically, inflation is kind of starting to moderate again, move back in the right direction. And that's good for the kind of Fed's ability to, have a little bit more leeway to operate. Their hand isn't being forced. On the left, we show the PPI for goods and services. The goods are in orange there. They weighed on the broader PPI figures. They were down for the second month in a row. And again, this is, energy falls into this because it's goods. It's not services for the most part. But they're now back to 6.35% year over year. And then services were up for the second month in a row, but have been moderating on a year over year basis and kind of pulled back a bit to 3.92%. They were led by a 2.2% month over month increase in construction services. And then on the right, both food, which is blue, and energy is green, posted their second consecutive down months. Food prices fell basically 1% month over month, while energy was down 3%. But energy is still up, similar to CPI. You get 2 down readings, but because of the huge spikes we saw earlier in the year, energy is still up 18% year over year for producers. And food is actually back into negative territory year over year. down 5 bips, which is the lowest since March. But you can see that food number is really kind of, there were some issues. And again, it is muted by the huge energy energy numbers that we're scaling it with. But people were concerned a couple years ago. You remember bacon, eggs, all that talk. Really just breakfast foods, I guess. But but they're now negative year over year. Also, kind of coming into the downside were retail sales in July. They fell 60 bips month over month, far below forecast for a 0.1% increase. That's also the biggest decline since May of 2025. Year over year, this is the headline number on the left. They're up 5 year over year. But again, there are a lot of the kind of notes cited that this was more likely due to timing rather than just outright weakness, where I think Amazon and Target's, kind of big Prime Day for Amazon and Circle Week for Target or whatever it was, were pulled up into June back from July. So that kind of pushed the timing up a bit relative to where it was last year, which is why you saw this drop year over year and month over month. And then core retail sales on the right missed, falling 0.24% versus increases expectations for a 0.3% rise. That's the biggest monthly pullback since January of 2025. And they're back down to 4.75% year over year. We think it is important, though, that you keep in mind these are largely in line with pre-pandemic levels where things were just humming right along. And also we had free money. Like there was it was a very different environment prior to 2020 before the Fed hiked 550 bips. So the fact that people are still spending at 5% year over year, the Red Book numbers continue to be solid. So that's kind of a more weekly, more high frequency data point. But basically, we don't think this is a big sign of consumer weakening. You can see on the category basis on the left there, this is the month over month. Clothing and accessory stores, a lot of this is like back to school shopping. Health and personal care stores as well. Then on the left, again, non-store. That's kind of a big tell that this is like Amazon, because Amazon is like non-store. They don't have many physical stores. Exactly. So those were down basically 2.2 month over month, and then you saw autos down as well. I think part of the autos as well is people were spending their tax refunds. And they're kind of, not stimulus, but, kind of dollars from the government coming in, transfer payments, and that slows down, but they use it to maybe put a down payment on a car. And once you do that once and then it stops. On the right, you can see the categories on a year over year basis. Gas stations up the most at 16%, again, just on high prices. And the miscellaneous stores at 10.7. And furniture's down the most at -1.2, and groceries up 0.8. And again, there's only one category that's negative year over year. So that's good for spending. That means people are spending more in every category, basically except for furniture. And that's, I think we're still kind of dealing with, remember the pandemic forced a lot of people to kind of upgrade their homes, living areas, home offices, and that's kind of still working its way out, I think, on that furniture side. Switching gears a little bit, we got the NFIB Small Business Optimism Index. That actually jumped to 99.8 in July, the best since August of 2025, and solidly above forecasts. The 2.4 point month over month move was the biggest since May of 2025. And again, this is nice to see this report kind of turning after the last couple of months where companies were like, oil prices are high, energy input prices are high, we're going to stop hiring because we're not sure on the geopolitical backdrop. And so you kind of seen this decline in uncertainty. The single most important problem right now is quality of labor on the right there, which is that maroon line. That shot up to 27%. That's tied for the highest in multiple years. While inflation and taxes fell back to 14 and 16 respectively. So again, what people were concerned about, or businesses were concerned about inflation and taxes, now it's really quality of labor. And you can see that on the left here with the employment picture, where hiring plans and positions not able to fill right now rose markedly. Hiring plans hit +20. This is net hire minus lower, so 20% more firms planning to hire versus reduce. That's the highest in September of 2022. That's great. That's what you want to see firms, planning to hire over the next couple of months. Employment changes fell to -5, and again, that's actual changes. So I think companies kind of said, all right, we're going to hold off on expanding and wait and see if this geopolitical kind of economic environment clears up a little bit, inflation starts to pull back. So that's a good thing. Hopefully, you're seeing some more confidence going forward with firms planning to hire. And then, interestingly, kind of the sales picture, though, didn't show much improvement, which I think that's kind of overall a good thing. If you don't have a whole lot of sales positive changes in expectations, but you're still planning to hire, you have more confidence in kind of the business overall. So the sales expectations actually ticked down to +7. That's higher minus lower. And then actual sales versus the prior 3 months were were unchanged at a net -4. So firms are actually seeing lower sales versus prior 3 months, but planning to hire.
I was going to say on the headline optimism number, it's funny how if you tell me what the CPI is doing month over month, I can basically tell you what a lot of other economic indicators are
especially on the sentiment side.
Anything sentiment or optimism related.
Yeah.
It's like if CPI is lower, okay, great, we're happy. If CPI is higher, oh no, everything's so terrible.
It shows up very, very quickly.
Yeah. So you can kind of see that here. And then on the employment side, that's a really good sign to me. Obviously, the labor market's been kind of chugging along here, stronger than it was maybe at the start of the year, but overall not in a super amazing spot. And this shows maybe it's even better than some of the other readings have shown, or heading in that direction, or maybe it's just a one-off reading, but overall positive for the labor market.
Yeah, agree on that one. We also got the Q2 2026 report on household debt. Total household debt declined slightly. This is on the left there, down $13.5 billion quarter over quarter. That's the first decline basically since Q2 of 2020, which if you remember the kind of pandemic recession was March and April. So it shows up as 2 quarters because it was 1 month of each of those. It was really just March and April. And that's been quite a while there. Since then, over that time, so we did have a little decrease Q over Q, but total debt has gone from 14.3 trillion to 18.8 trillion. So it's up 31% over that time. And part of this is also mortgages are a big part of this. Mortgages are that was basically responsible for the decline. Mortgages debt fell $75 billion quarter over quarter. That's the biggest drop since 2013. So that's a long time coming. Mortgage debt makes up 70% of household debt. So while credit card was up 21 billion and auto debt up 28, it still wasn't enough to make up for that decline in mortgage debt. And part of the reason that, as we mentioned, that overall household debt has gone up is because as housing prices have gone up, when you take out a mortgage, you're taking out a larger mortgage, even if you're still on a dollar basis. And these are on dollar basis. On the delinquency status, people have kind of been raising some flags around this, where you saw on the left current delinquencies. So that means people are up to date on them. Actually ticked up to 95.3, right in line with historical levels. So again, that's the important number we think. Where it kind of spiked up to 97, 98, and has come back down. So we want to see that kind of moderate around its long-term median of 95, but severely derogatory at 2%. That's the highest since Q3 of 2020. So that's a little concerning. However, 120-day, 90-day, and 60-day delinquencies all declined, and then 30-day was up a little bit. The transition rates on the right show that 30, 60 days late into current. So if you're like 1 or 2 payments behind and then you make up for it, that actually declined a little bit. And then on the right, that orange as well, kind of 30 to 60 into 90 days also declined. So I think, the point is that it's kind of steady as she goes for the time being. Not great to see that severely delinquent or severely derogatory figure rising to 2. We'll see if that tapers off here, as you can see the other ones did as well. And finally, we did get existing home sales. I mean, if you could just skip the slide, just say it's still stuck. It's been stuck for the last couple of years, still stuck. They're up 0.7% year over year at 4.06 million. Back, in line with forecasts. On the right there, you can see the prices are continuing to rise. We hit 434,000 in July, which is a bit lower than June's almost $445,000 from a median existing home. And this is the seasonality coming back into play. So if this keeps, we'll get a few months of pullback and then we'll be back to new highs. You can see that 12-month figure, that dotted line really keeps posting new highs, and it's done so every month since like mid 2023. So that's why the housing market is stuck, because ever higher prices, high mortgage rates, and nobody's got a break. So that's still stuck. Sorry if you're out there trying to buy one. Not a fun market to be in. In summary, CPI in line with expectations. PPI slowed considerably. So those kind of leave the Fed more leeway to operate. Retail sales missed, but more likely on timing rather than just outright weakness. NFIB small business optimism improved, boosted by that CPI. That inflation kind of correlates directly in there. But hiring plans have markedly improved across the board for those NFIB small business respondents. As you saw, household debt declined for the first time since Q2 of 2020 on mortgage debt mostly, and then existing home sales are still stuck. This week, you got kind of a little pullback in data. Last week is very inflation heavy. This week, the kind of bigger reports are industrial production on, Tuesday? And then you get the flash PMIs that people will be watching on Friday. So those are kind of the big ones. But again, thanks for joining us as always, and we hope you have a great start to your week.
Thank you.
Thank you.